Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, ETFs versus mutual funds. Which belongs in your portfolio? And, over the last decade or so, we've seen literally trillions of dollars just quietly migrate out of traditional mutual funds and straight into ETFs.
Yeah, it's a massive shift, truly massive.
Right, and today we're really opening the hood to find out exactly why the plumbing of the financial system is like forcing this migration. So we've pulled together a huge stack of research for you today.
We have data and structural analyses from the CFA Institute, Investopedia, Morningstar, the SEC, and Fineraya.
Exactly. And the goal here isn't just to, tell you what these funds are. I mean, if you're managing your own portfolio, you probably already know they're both basically just baskets of assets.
All right, that's the baseline.
Yeah. But what we're doing in this deep dive is dissecting the hidden machinery behind them. We want you to see how the structural differences in market plumbing actually directly impact your tax bill and your long-term compounding.
It's such a critical teardown to do.
Yeah.
Because, on their face, they serve the exact same function for a portfolio, right? Instant diversification.
Exactly.
But the actual architecture supporting an ETF versus a mutual fund, I mean, it couldn't be more fundamentally opposed. One is this highly efficient product of modern financial engineering. And the other operates on infrastructure that hasn't fundamentally changed since, the early 20th century.
Okay, let's unpack this, because I think we should bypass the basic definitions and just jump straight into that structural divide.
I agree. Let's do it.
So the clearest way I can visualize this for you listening is to think of an ETF as a pre-packaged variety box of snacks.
Okay, I like where this is going.
Right, like something you can just grab off the shelf at a convenience store, you can buy it, or you can sell it back to another customer at literally any single hour the store is open.
And the price fluctuates second by second.
Exactly, completely transparent. But a mutual fund, on the other hand, is more like a catered dinner party. You pool your money directly with a group of other investors to hire this professional chef or management team. But the catch is, the caterer only settles the bill once a day.
Right, at the end of the night.
Yeah. Everyone buys in or cashes out at the exact same time.
That analogy actually scales perfectly when we look at the actual trading mechanics. Because with an ETF, an exchange-traded fund, you are transacting on the secondary market.
Right.
So if you decide to allocate capital to, say, an S&P 500 ETF at 10:30 a.m., you execute that trade with another market participant right then and there at the live intraday price.
You're just swapping shares with someone else.
Exactly. But with the mutual fund, you're transacting directly with the fund itself on the primary market. So you put your order in at 10:30 a.m.
It just sits there.
It just sits in limbo.
Right.
It sits there until 4:30 p.m. when the market closes. Then the fund accountants have to tally up the closing prices of every single asset in the portfolio, and they calculate the net asset value.
The NAV.
The NAV, exactly. And that is the price you get.
But, I have to challenge the utility of that, though.
Okay, challenge away.
Because if I'm a regular investor saving for retirement, 20 years from now, I'm not day trading.
Sure.
So why should I care if I can trade at 2:00 p.m. versus the end of the day? Does intraday liquidity actually matter for a long-term buy and hold strategy, or is it just some shiny feature for institutional traders?
Well, if we connect this to the bigger picture, the intraday pricing itself might not matter to your specific strategy, but it is the byproduct of a much more important feature, which is the underlying plumbing.
Okay, so it's a symptom of something bigger.
Exactly. To understand why ETFs have been, eating the mutual fund industry's lunch, you have to look at the machinery that allows them to trade intraday in the first place.
Right.
This is where we get into the creation and redemption process. When you buy an ETF share on the open market, you're just swapping cash for shares with another investor, like we said. But that raises this massive structural vulnerability. What prevents the market price of that ETF from wildly detaching from the actual value of its underlying assets?
Oh, I see. Because if demand for the ETF suddenly spikes, the price of the ETF shares would skyrocket,
Right.
even if the actual stocks inside the fund haven't moved an inch.
That is the logical fear, yeah.
Mm-hmm.
But Wall Street engineered a failsafe for that, and they're called authorized participants, or APs.
Wait, who exactly are these participants? Am I an AP?
Oh, definitely not, no. These are massive institutional broker-dealers. They have a unique, legally binding agreement with the ETF issuer. They are literally the only entities allowed to interact directly with the fund to create or destroy ETF shares.
So it's essentially like a grocery store where a secret, massive supplier is just waiting in the back room.
I love this grocery store theme we have going.
Right. So whenever the price of the pre-made pizza gets skewed from the cost of the raw ingredients, the supplier instantly swaps crates of raw ingredients for new pizzas.
Vice versa.
Yeah, to force the price back into alignment.
That is the exact mechanism. According to the sources we pulled, these APs transact in massive blocks called creation units, and that's typically like 50,000 shares at a time.
Wow, okay, 50,000.
Yeah. So let's walk through the arbitrage really quick. Say the market panics, right? Investors flood into a specific bond ETF, and that drives the market price of the ETF significantly above its actual net asset value.
Because everyone's buying the ETF wrapper.
Exactly. The AP sees this premium, so they immediately go into the open market, buy up the underlying bonds at their true lower price, bundle them together, and hand that basket of bonds to the ETF issuer.
And the issuer hands them back a newly minted 50,000 share creation unit of the ETF.
Which the AP immediately turns around and sells into the open market at that inflated premium.
Oh, so they just pocket the difference.
They pocket a risk-free arbitrage profit. And by flooding the market with those new ETF shares, they drive the ETF's price back down until it perfectly matches the NAV.
That's incredible.
And if the ETF is trading at a discount, they just run the engine in reverse.
Okay, so they buy the cheap ETF shares, redeem them for the underlying bonds, and sell the bonds.
For a profit, yes. This constant, relentless arbitrage is basically the financial gravity that keeps the ETF tethered to reality.
And the beauty of this from the perspective of the retail investor is that, like, this entire industrial scale arbitrage operation happens completely invisibly.
You never see it.
You never see the APs, you just get a fairly priced fund. But this leads directly to the most critical variable for long-term compounding, which is the cost structure.
Oh, absolutely. The cost difference is huge.
Yeah, the Morningstar data in our research stack highlights a massive gulf here. Because the average expense ratio for an ETF sits around, what, 0.20%?
Roughly, yeah.
While mutual funds average closer to 0.50%, and some active ones push well past 1%.
And that fee compression isn't just because ETFs are traditionally passive index trackers. It's actually a direct result of outsourcing the administrative burden.
Okay, how so?
Well, think about the operational overhead of a mutual fund. Because investors transact directly with the fund, the mutual fund company has to act as a massive transfer agent.
Oh, because they're dealing with all of us individuals.
Exactly. They're maintaining shareholder registries for millions of people. They have to process fractional share cash inflows and outflows every single afternoon.
Mailing out prospectuses, fielding customer service calls.
All of it. They manage the internal accounting of all that capital movement, while the ETF issuer outsources almost all of that friction to the secondary market.
Right, because if I buy shares of an ETF, my brokerage firm handles the record keeping. The ETF issuer only ever deals with those handful of authorized participants moving those massive 50,000 share blocks.
Right. Their administrative overhead is practically non-existent by comparison. And furthermore, that daily cash flow in a mutual fund creates something called cash drag.
Cash drag.
Yeah. A mutual fund portfolio manager knows that on any given day, thousands of investors might demand their money back at 4:00 p.m. So to meet those redemptions without having to fire sell their best stocks, the manager has to keep a portion of the fund's assets in liquid cash.
Which means if you invest in, say, an aggressive growth mutual fund, you aren't actually 100% invested in the market.
No, you're not.
A chunk of your money is just sitting in cash, yielding very little, which drags down your overall return during a bull market.
Exactly. And the ETF doesn't have that problem because the AP handles the liquidity in the open market, allowing the ETF to remain fully invested at all times.
Wow.
It creates a compounding head start for the ETF that is, frankly, mathematically devastating to the mutual fund over a 20-year horizon. You're forcing the active mutual fund manager to clear a much higher performance hurdle just to break even.
Here's where it gets really interesting, though.
Right.
Because if we stop the analysis here, I feel like we're doing a massive disservice to you listening. Right now, the ETF looks like a flawless financial vehicle. It's cheaper, it's highly efficient, and it's insulated from cash drag.
It does sound pretty perfect.
Right. And Wall Street knows that investors have caught on to this, which brings us to the first major misconception we need to navigate. The term ETF has essentially become a Trojan horse.
This is a crucial pivot in the industry right now, because for decades, ETF was practically synonymous with passive index tracking.
Right, and mutual fund meant active management.
Exactly. But the CFA Institute research explicitly warns that this line is completely blurred. We are currently witnessing a massive proliferation of actively managed ETFs.
Meaning Wall Street is taking the expensive, traditional mutual fund chef and just stuffing them inside the cheap convenience store wrapper to attract capital.
Basically, yes. They are utilizing the superior plumbing of the ETF structure to deliver active strategies. So you now have portfolio managers picking highly concentrated stock portfolios, running complex algorithmic trades, or deploying options strategies like covered calls.
And it's all entirely within an ETF wrapper.
Entirely.
So you absolutely cannot blindly buy a ticker symbol just because it has the letters ETF next to the name and assume you're getting a cheap, broadly diversified passive investment.
Not anymore. You can't. The structure no longer dictates the strategy. The CFA Institute data shows that these active ETFs often carry expense ratios that rival traditional mutual funds, sometimes pushing 0.75% or higher.
Wow.
Furthermore, because they're taking concentrated bets, you introduce severe manager risk and you lose that broad market safety net that most investors associate with the ETF acronym. You have to open the prospectus and investigate the underlying methodology.
And I think that is a perfect transition to the second major pitfall here.
Yeah, let's hear it.
Let's say you do your homework. You find a passive ETF and an active mutual fund, and you're willing to pay the higher fee for the mutual fund because you really believe in the manager's strategy.
Okay, totally valid choice.
Right. But there is a silent killer lurking in the plumbing of mutual funds that you have absolutely no control over, and it can just shred your long-term returns.
Taxes.
Taxes.
Taxes are arguably the most consequential differentiator between these two vehicles. To understand the tax drag, we have to return to your catered dinner party analogy.
Oh, I'm glad we're bringing it back.
Yeah. So imagine the party is halfway through the main course, and suddenly 20% of the guests just panic, decide they want to leave right now, and demand their money back from the caterer.
So to pay them out, the caterer has to suddenly run to the back room and sell off the expensive wine and the reserve ingredients they had bought for dessert just to raise the cash.
Exactly. In the financial markets, when a large number of investors redeem their mutual fund shares, the portfolio manager doesn't just hand them cash out of thin air. Once they exhaust that cash buffer we talked about earlier, they are forced to liquidate actual underlying securities, stocks, or bonds to raise the necessary capital to pay off those exiting investors.
And when a portfolio manager is forced to sell a stock that has appreciated in value, they trigger a capital gains tax event.
Here is the brutal reality of the mutual fund structure. By law, mutual funds are required to distribute those realized capital gains to all the remaining shareholders at the end of the year.
Okay, let's put this in a real-world scenario so you listening really feel the impact of this.
Good idea.
Let's say you buy into a mutual fund today. You hold it for 5 years. You haven't sold a single share. You are being a highly disciplined, long-term investor.
Doing everything right.
Doing everything right. But the market hits a rough patch and thousands of other investors in your fund panic and hit the sell button. The manager is forced to liquidate a massive position in, say, a big tech stock that the fund has held for 10 years. That triggers a colossal capital gain. Because you are still sitting in the fund at the end of the year, you get handed a tax bill for a gain you never personally realized on a stock sale you didn't ask for simply because other people panicked.
It's awful. It is entirely outside of your control. You suffer the tax consequences of other investors' behavioral mistakes. This forced liquidation creates an unpredictable and highly frustrating tax drag in taxable brokerage accounts.
Which begs the obvious question for the ETF, right? If an ETF tracks an index and stocks are constantly moving in and out of that index, or if APs are redeeming massive blocks of shares, why doesn't the ETF trigger those same capital gains for its investors?
It goes back to the authorized participants and a vital mechanism called the in-kind transaction.
In-kind. Okay.
When an AP wants to redeem 50,000 shares of an ETF, the ETF issuer does not sell underlying stocks to raise cash. Instead, they operate on a barter system. Yeah, the ETF issuer simply takes a basket of the underlying stocks and hands those actual shares directly to the AP in exchange for the ETF shares.
Wait, so there is literally no cash transaction inside the fund?
None. Because the securities are transferred in kind rather than sold for cash, the IRS does not view it as a taxable event for the fund itself.
Oh, wow.
So the ETF can continually flush out low-cost basis shares to the APs during these redemptions, effectively wiping capital gains off the internal books without ever triggering a tax bill for the buy-and-hold investors who remain in the fund.
That is a brilliant piece of financial engineering.
It really is.
But we do need to clarify a massive caveat here, because a lot of people hear this and think an ETF is some kind of magical tax-free offshore account.
Right, right.
And Investopedia is very explicit in our source material about where this tax protection ends. Wait, so if I buy an ETF, am I totally immune to taxes?
Definitely not. No. The ETF's in-kind machinery only protects you from internal portfolio turnover and the actions of other investors. It insulates you from collateral damage. However, it does absolutely nothing to protect you from your own success. If you personally buy an ETF share at $100, hold it for a year, and sell it on the open market at $150, you have realized a $50 capital gain.
And you are entirely responsible for paying the capital gains tax on that profit.
Yes, you cannot escape the IRS on your own realized gains. The structural advantage is simply that you decide when to take that tax hit, rather than having the fund manager force it upon you in the middle of December.
Right. And control over the timing of taxation is one of the most powerful tools a long-term investor can have.
Absolutely. It allows you to strategically harvest losses or delay gains until you are in a lower tax bracket in retirement.
So what does this all mean? We have mapped out the plumbing, the arbitrage, the hidden fees, and the tax traps. When you synthesize all of this data from Morningstar, the SEC, and the CFA Institute, the narrative seems incredibly lopsided.
It does lean heavily one way, yeah.
ETFs offer superior tax efficiency, lower operational costs, and they don't suffer from cash drag. So for you, the listener trying to construct a portfolio today, does the traditional mutual fund have any remaining utility, or is it just a legacy product slowly bleeding assets?
Well, to answer that, we have to look at the guidance from FEDRA. They emphasize that portfolio construction isn't just about finding the most technologically advanced vehicle, It is about matching the financial product to your specific operational constraints and your behavioral psychology.
Let's explore those constraints, like where does the mutual fund actually win?
One major area is highly automated, fractional investing, specifically within employer-sponsored retirement plans like a 401k.
All right.
Because mutual funds are priced once a day at NAV and they transact directly in cash amounts, it is incredibly easy to set up a system where exactly, say, $500 from your paycheck automatically buys fractional shares of a mutual fund every 2 weeks.
You don't have to worry about bid-ask spreads on the open market or intraday volatility, or whether you have enough cash to buy a whole share.
Exactly. You just blindly dollar cost average into the market, and the mutual fund's end-of-day NAV pricing accommodates that perfectly.
And many mutual funds also allow you to automatically reinvest your dividends right back into the fund at no extra cost, which seamlessly compounds your returns.
Yeah, and while many brokerages now offer fractional ETF trading and automated ETF dividend reinvestment, the mutual fund structure was fundamentally built for this exact type of automated capital accumulation.
But beyond the operational side, there is a fascinating psychological angle here. We established earlier that the defining feature of the ETF is intraday liquidity. You can sell your entire portfolio at 10:30 a.m. on a Tuesday.
Right.
But if we look at behavioral finance, is that frictionless liquidity actually a benefit for the average retail investor?
This raises an important question for anyone managing their own money. We spend so much time analyzing expense ratios and tax drag. But the biggest destroyer of wealth is investor behavior specifically, panic selling during market drawdowns.
If you're holding an ETF and the market flashes red after a bad inflation report, you are literally one screen tap away from liquidating your entire retirement account in a moment of sheer panic.
The convenience store is always open.
And the exit door is wide open.
Right. But contrast that with the mutual fund. The end-of-day NAV pricing acts as a structural speed bump.
A speed bump. I like that.
Yeah. If you panic at 10:30 a.m. and put in a sell order for your mutual fund, you have hours to cool off, rethink your strategy, and potentially cancel the order before the market actually closes at 4:00 p.m.
The friction is built into the system.
Exactly.
The catered dinner party forces you to sit at the table. You can't just run out the door the second someone drops a plate.
The friction is a feature, not a bug. For a highly disciplined investor who wants to minimize taxes and fees, the ETF is structurally superior. But for an investor who knows they are prone to emotional decision-making, the slightly higher fee of a mutual fund might be worth paying if it prevents them from making a catastrophic behavioral error during a volatile trading day. It really comes down to knowing your own psychology.
You have to know what game you are playing, and you have to know yourself before you pick the equipment. If you take nothing else away from this deep dive, realize that the label on the fund doesn't matter nearly as much as the plumbing underneath it.
Well said.
Whether you choose the massive arbitrage engine of an ETF or the pooled end-of-day structure of a mutual fund, just understand how your choice impacts your fees, your taxes, and your behavior over the next 20 years. That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.